Over the years, we've been doing a lot of work with banks, helping them with designing their credit policy, credit processes. One thing that always comes up in all the discussion is how do you deal with this beast called SMEs, right? I mean, you have a large retail portfolio. Obviously, banks have a corporate credit, function. But when it comes to SME credit, right, it becomes a little bit in between, because you don't want to really apply the principles of corporate banking, corporate credit in a SME context, which generally becomes more retail, and it's very hard for you to deal with this beast. And over the years, you also realize that, especially a post-COVID environment, and with a lot of stuff happening around in the fintech world, the orientation that banks have taken towards SME and commercial credit and business banking, as they call it, has become increasingly, let's say, different than what it has been. We all know that more than 50% of global GDP comes from SMEs, and more importantly, 80% of employment is from SMEs. So it's a very important segment. It can't be ignored. And the challenge you always have is that the risk of the enterprise in an SME is almost the risk of the promoter. So to that extent, from an obligor standpoint, debt and equity is almost blurred, and it becomes critical that you apply the principles that you need to have in a context of SME credit, very different from what traditional corporate credit has been, right? So to start with, there are 4 or 5 principles that we recommend that we keep in mind. To start with, it's always important that we measure the assessment of the borrower is driven more by, let's say, the cash flow, less by the financial statements. It's hard for you to have, high quality financial statements, which obviously is always a challenge. So a cash flow based assessment becomes critical, but more importantly, the principles of underwriting, the framework with which the underwriting happens is critical, right? I mean, as they say, it's always a function of measuring the ability to pay and willingness to pay. The willingness to pay generally gets measured by the credit score more often than not of the obligor, but the ability to pay is a critical factor in an underwriting, in a SME underwriting context, and there you always have collateral playing a very important role. Using a different parlance, the probability of default is what you measure with the credit score, but the loss given default is actually measured more by the quality of collateral. So generally what we recommend is that when you actually have the credit score high, as in the probability of default being low and the loss given default being low with the high collateral, which is what you would normally call as a tier 1 segment, and then you gradate the segments based on gradient 1, 2, 3. The high tier segment is what you should actually have your underwriting framework made to be very friendly with, right? Be it in terms of the term, be it in terms of the rates, be it in terms of the documentation, be it in terms of the sheer process and the turnaround time that is built around it. It's always useful to actually have a tiered structure and approach, and therefore you align your processes and your turnaround times around what could be a tiered approach. So you actually you do want to treat your tier 1 segment, who obviously are in demand, because there are the tier 1 customer always has more options in the market, and then you also build the whole credit organization different from what it would be for a retail or a corporate credit, right? So having an SME credit organization is critical. But the most important piece that we always see in a credit context, especially SME credit context, is the quality of credit is a function of how good your portfolio management is, how strong is the early warning assessment and the portfolio assessment. Of course, having a strong collection recovery system, but I guess a lot to do with effective portfolio management that manages that is reviewing not just the obligor and the credit individually, but also collectively as a segment or as an industry. To summarize, I guess it's important to recognize that in many situations it's almost like like a private equity context, where you are looking in the eyes of the promoter and making a decision if this credit is good, because debt and equity, as I said, in an SME context is somewhat blurred, considering that the risk of enterprise and risk of the borrower, of the entrepreneur, is almost the same. It's important we actually deal with that context, and it's a function of having a good underwriting framework, having the right processes in place, a good credit SME credit organization, and most importantly having a good portfolio management and early warning measurement in place. End of the day, credit is the heart of a bank, and as they say, with the change in the environment, SME credit is much more important than ever before.